we're actually starting an important section because when looking at capital budgeting, we're looking at okay, we're looking at allocating resources to different projects, and we're looking at choosing the project that reaps the most benefits.
Yes, sir.
So topic 8 is focusing on that. It's looking at capital investments and capital budgeting. Investment means we're going to receive some sort of return. And the budgeting means how much are we going to be allocating in terms of the costs.
Yes, sir.
So when looking at these types of questions, you need to look at both. You need to look at the income, okay, which is the return, and you need to look at the costs, which would be the outlay, okay, so the resources that you're going to have to invest.
Yes, sir.
The first bit is introduction, and then they talk about capital investments. So let's discuss what that is. What is a capital investment?
Perhaps it could be an investment of, well, obviously an investment of capital. Maybe you could be perhaps you're buying equity of some sort, and that investment, as in you getting a portion of the business, is probably what we'd be looking at.
Okay, that's good. Okay, so when you invest, if you're taking capital, remember businesses need to maximize a return on investment. So their capital needs to grow and their capital needs to pay back something. Right, so capital is the resources we're going to be allocating to a project. Okay, so if I'm buying a new property, that property is going to be generating revenue in the form of rent income. Do you agree?
Yes, sir.
Alright, so if I was buying a business, then I'd be buying what? Well, the sales or the services that I'm going to be selling, right?
Yes, sir.
Okay, so capital investment is look at the initial. Okay, the initial investment. Okay, and you've done DSC 1630. So you know that there is a net present value calculation that you can do.
Yes. Yes, sir.
Okay, you're familiar with net present value. You've done it before. We just need to apply it to finance now.
Okay.
Okay, it's actually exactly the same. You just need to think about the different scenarios firsthand before actually creating the timeline before you're discounting things back in time. Okay, so the objective in terms of capital investments, the objective is quite simple. We obviously want to create long-term wealth. That's the key. You want to create as much wealth as possible over the longer term. And that requires investing in short-term projects, in short-term things that will provide us with benefit in the future. Okay, and then as we said,
yes,
if we keep allocating resources and those resources grow, then we'll have wealth in the future. Is that right?
Yes.
Okay, so
yes,
when looking at investment decision, you see they've highlighted a few words here. They want you to increase long-term sustainable value of the organization. It's always about value, not profit. Okay, remember, businesses can make a profit in the short term and they go bankrupt in the long term.
Yes,
businesses that focus on the long term aren't going to go bankrupt because they're basically existing because of a specific goal rather than, well, how much profit can I take out of this?
Yes,
okay. That's what businesses need to do. The businesses need to have a clear goal, a clear long-term sustainable value that's being created. Okay, and then obviously short-term actions or short-term projects or short-term assets will be generating the income that will hopefully be able to be compounded in the future so that the business can grow in the future.
Yes, sir.
Okay, so that's the objective. The objective is to achieve long-term growth or wealth, and we do that by maximizing our long-term value. Right, they talk about sustainable capital budgeting. Are we going to allocate all our resources to one project?
No, sir.
No, it's probably not a good idea. So funds need to be allocated accordingly, and that's where the budgeting comes into it. Okay, so capital budgeting is looking at where do we allocate our resources. Right, so if we've got 5 projects to choose from, we need to choose the best project first, and that's the project we're going to invest in. And then we'll accept the next project, and then the next project, and then the next project. With capital budgeting, you're looking at allocating the resources to the best projects first, or projects or investments, or whatever. It could be anything. Projects / investments / assets. Doesn't matter what it is, but it's going to be generating value. Okay, that's what you're going to be looking at doing in terms of budgeting. Makes sense?
Yes, sir.
Okay, so if I'm looking at sustainable capital budgeting, we're only going to be choosing projects that give us a profit or an acceptable return in line with the risk. Okay, that was your CAP-M.
Yes.
This you could relate back to CAP-M. If I take on a specific project at a specific level of risk, what do I require as the required return? Okay, that sort of links back to CAP-M. Here they're talking about the capital budgeting in terms of allocating resources to different projects, and we need to be assured of the profitability as well as the acceptable return. Meaning, we need an expectation of cash flow, bracket, inflows getting or coming from the project / investment / assets, etc. Okay, so that's what you're going to be looking at doing. You're going to be getting an estimate, and that's where your net present value calculation comes into it. Okay, we're not going to look at net present value tonight. We'll look at the 2 easy ones, and then we'll cover the rest next week. Okay, so it'll just be a bit too much for today. Okay, but you are familiar with net present value from DSC.
Yes, sir.
Okay, good. Right, so types of capital expenditure. There are many different types of capital expenditure in terms of I can invest in a property. That's a form of capital expenditure. Remember, capital expenditure is CapEx.
Yes, sir.
I could invest in a building. I could invest in machinery. I could buy vehicles. I could buy equipment. Okay, all of that would be considered capital expenditure. Something that I'm purchasing that's going to hopefully generate income.
Yes, sir.
Okay, so CapEx is investing in non-current assets that add value, not value, capacity for creating value. Okay, so let me ask you this. If you buy the top of the range camera that can film 360 videos, do you think that's going to add income producing opportunities?
Is it going to add what, sir? Sorry?
Is it going to add income? Is it going to add income producing activities to the business?
Yes, sir.
Yes, it would. Okay, so if you buy a new camera that can film 360 videos, well, that's better than just taking normal videos or taking photos.
Yes, sir.
Right, so do you see how CapEx is actually a way to add capacity? It's to give more opportunity for the business to offer value in the form of products or services. Right, so that's what we're looking at in terms of CapEx. Okay, we're buying something, we're investing in something that's going to give us more capability or capacity in order to operate and create more value in the future.
Yes, sir.
Okay, that's what they've described there. They talk about a capital budget. All businesses will have a budget. Why do businesses spend money? Well, there's 3 different reasons. They can either upgrade or repair an existing item, they can replace it, or they can expand. Those are important considerations in terms of capital expenditure. Right, so why buy more non-current assets or CapEx? Why spend, let's write that down, why spend more on CapEx? Question mark. Okay, well, number 1, to repair or upgrade existing equipment, machinery, existing assets. Right, so that's something that you would think of in terms of generating more capacity or more capability. Right, so if you've got
Yes,
a
sir.
camera, that's like buying a new lens.
Yes, sir.
Sorry. Okay, so if I've got a camera, if I'm buying a new lens for the camera, that would be seen as a repair or an upgrade. Okay,
Yes,
the
sir.
other reason could be replacement. Okay, so now I'm not buying a new lens, I'm buying a new camera actually. Okay, because the
Yes, sir.
technology has improved. Okay, so now we're buying a camera with more higher definition. Okay, more pixels and so on. Okay, versus expansion, now I'm buying an extra camera. Does that make sense?
Yes, sir.
Alright, so all three of those reasons would be motivation why you would spend money on CapEx. In other words, in our example, why we would buy more camera equipment. Okay, the reason could be we need to upgrade, we need to repair existing equipment. Okay, so maybe the lens gets damaged and that's why we're buying a new one. Okay, that could be a repair.
Yes, sir.
Versus buying a new lens would be maybe an upgrade. Replacement,
Yes, sir.
getting rid of the old camera, buying a new one. Expansion, keeping the old camera, but buying a second one. Got that?
Yes, sir.
Nice.
Yes, sir.
Okay, so they give you some examples here. It's just theory. They talk about identify the type of capital that you can have a look at when you've got some time. This is important though, the project analysis. Okay, project analysis. Okay, this is focusing on creating I want to call it a report on whether the project, or on whether or not we should or let's say report on the facts of the project / investments / assets, etc. Okay, it's a report, so the analysis. But remember, do we choose projects because we like projects, or do we choose projects because they actually create value?
Because they create value, sir.
Exactly. Okay, so we're not going to buy the camera lens if the camera lens isn't going to add value. Okay, we're not
Yes.
going to replace the camera if the replacement camera is not going to create value. We're not
Yes.
going to buy a second camera if the second camera is not going to add value.
Yes, sir.
Okay, and that's what we're looking at here. We're looking at the project analysis. So there's a few things that they mention here in terms of theory. The process. You need a proposal. Then you need to evaluate. Then you need to select. Then you need to implement. Okay, I'm going to take this from the actual textbook because it summarizes everything in terms of the actual process, and it's well laid out over here. So I'm just going to copy this here through to your notes. Okay, so let's paste that there. Right, so this is the project analysis process. Let's summarize each of these. Okay, so let's talk about the generation. Project, proposal, generation. Okay, so tell me, let's talk about cameras. Proposal, generation. What's
Yes,
the
sir.
proposal?
Well, the proposal would be perhaps to get propose to get a new camera that does video and has higher megapixels. That does better video, 4K video, and better images.
Okay, good. So that's the proposal. So you create the proposal. Obviously, the proposal needs to be detailed. It needs to explain what are you going to do. It needs to give all the different considerations. Okay, it needs to give the plan. Right, the next part is going to be looking at evaluating it. Right, so evaluation is going to be looking at like cash flow analysis. Right, so now you've got this new camera. What is it actually going to do? Okay, so the example could be, well, now we have inflow or increase in inflow from separate revenue streams. Okay, so now we're going to do 4K videos, and we're going to offer that as a product, or a service rather, for our customers, our clients. Okay, so the evaluation is going to be looking at the data. Okay, the number crunching. Right, the ratios, the cash flow. Okay, it's going to be looking at all the number part, the quants, the quantitative.
Yes.
Quantitative. Okay, proposal generation, this is generally more qualitative. Okay, there can be some numbers there, but it's not the focus. The proposal is, well, what do you want to do and why do you want to do it? Okay, the evaluation is, okay, so now I know what you're doing. Okay, or what you're proposing, does that make sense? Is it going to generate value? Okay, what value are we going to be creating? Right, it's more quantitative. Right, then number 3 is obviously the selection. Now we need to choose. Project selection. Okay, this is looking at weighing up all the pros and cons. Or considering different options. Okay, so now we know we're going to buy a new camera, but now what camera do we buy? Do we buy a Nikon? Do we buy a what are the other big brands? Canon? Yeah, do we buy Canon? Do we buy
Fuji? Fuji?
Fuji? Yeah, what do we buy? That's the selection.
Yes.
Okay. And then number 4 is looking at actually going through with the process. That's the taking action part. Okay, the implementation, the monitoring, and the post-implementation. Okay, I like to call this the review. Alright, so now, after you've bought the camera, after you've used the camera, well, did everything go according to plan? Are you now selling 4K videos to different companies? Are you making a difference? Are you creating value? That's what you're looking at. That's the review. And if things aren't going as well, then you need to go back to step number 1, and now you need to think about a new proposal. Okay, if things aren't going well. If things are going well, great. Then we need to establish what the actual performance is. Are we making a big profit, a small profit? Are we creating value? Aren't we creating value? Right, it's all theory mainly. Right, so in the examples here that they give you in the textbook, they talk about proposal generation. Right, proposal, C, adding new products, expanding the production, reducing costs. They're all ideas. Okay, proposal is the idea. Right, the evaluation is going to be what impact or what value are we going to create. So what are the risks? What is the environmental, social, governance impacts? Okay, so in other words, what's actually going to happen? What's the outcome? What's the estimated benefits and costs? See that? There's it there. Let me actually highlight some of this. Okay, so I would highlight that in terms of project evaluation. It's the number crunching. Proposal generation, I'd be just looking at examples of proposals. That's all. Okay, you're looking at ideas. That's all. Okay, if I was highlighting something here, project selection. Okay, selection is going to be looking at the options. Okay, judging the attractiveness of a project. Okay, so which camera is the best? Okay, are we going to go with option A, B, or C? That's the project selection. And then the last bit is obviously the review. Okay, so was that a good idea? Did things work out as planned? What was the outcome? Okay, that's what we're looking at. It's more the review. Improve the capital, pros not. Okay, so not repeating mistakes. See, it's review. Okay, they didn't write the review word there, but I'm going to write it here. Okay, that's the review.
Yes.
Okay, good idea, bad idea. We won't know until we've done it.
Yes.
Right, then they've given you just some theory here relating to the classification of different projects. Okay, projects can fit into different categories. Okay, so let's discuss each of them separately. The first is independent and mutually exclusive. Okay, so number 1 independent projects, I'm just going to summarize, they're standalone. Standalone. Okay, standalone meaning they're not affected by anything else.
Yes.
Alright, so can I choose multiple projects? Yes. Multiple projects can be accepted. Okay, mutually exclusive is dependent projects. These rely on each other. Only one project can be chosen. Okay, because choosing one project eliminates the other project. Okay, that's a mutually exclusive project. Okay, those are the two most important ones. Okay, because we need to establish if the decision is going to affect anything else. Okay, so an example of that could be, let's see, independent project, standalone. Oh, okay, so for example, if I'm buying a new camera lens, okay, do you agree that camera lens, I can buy multiple camera lenses, do you agree?
Yes, sir.
Okay, so the camera lenses, I can buy a small lens, a big lens, a middle lens, I could buy all sorts of lenses. Okay, that would be
Yes,
an
sir.
independent project because I'm buying lenses for the camera. Mutually
Yes.
exclusive would be buying the actual camera. Okay, if I buy the actual camera, then I'm not going to use the old one. Does that make sense?
Yes, sir.
Okay, so buying the new camera would eliminate the old camera. Or replacement. Replacing the camera. If I replace the camera, that's mutually exclusive. Okay, independent would be I can accept or buy multiple lenses for the camera. Okay, so the one where the decision making affects it versus the other where it doesn't. It's independent.
Yes, sir.
Okay. Then they've got 3 and 4 contingent projects. Okay, with contingent projects, the acceptance of one project is contingent on the acceptance of another. So contingent means depends on. Okay, so this would be looking at stages. Contingent projects. Okay, this would be accepting one project that leads to another. Okay, so it's not quite dependent in terms of like the one will eliminate the other. It's like steps. So if I do this, then I can do that. It creates more
Yes.
opportunity. Okay, acceptance
Yes.
depends on acceptance of another project. Right, so I can't choose, so for example, I can't film 3D if I don't have a 3D camera. Okay, so the contingent project could be maybe to, let me think now, in terms of cameras, contingent would be accepting the one project will affect the other. Okay, so if I buy a camera that has VR capability, then that would be how can I put it? Would open up the door for buying other equipment that's related to 3D videos. Okay,
Yes.
so buying the camera or buying the equipment that can film 3D videos, okay, virtual reality, then if that's the case, then that will then give rise to contingent projects. So then buying all the accessories for that
Yes.
particular project. Okay, so the project is VR, then VR would be the focus, okay, in terms of accepting the VR project, which then opens up other projects. If that makes
Yes,
sense.
sir.
Okay, and then you've got divisible and indivisible projects. Indivisible projects. Okay, and the word basically explains what this is involving. Projects that can be divided and projects that can't be divided. Right, so can I break it down into smaller parts? Okay, or can't I? That's what you're looking at. Okay, divisible, easy. Just remember the word divisible. Okay, that's all theory.
Yes, sir.
Then they give you factors affecting the capital budgeting decision. We've spoken about risk. Okay, risk is always a factor. In your last few chapters, risk management is a big focus. Right now, we're just looking at capital budgeting. Okay, so how much funds do we have available? Do we have a specific capital structure? So am I raising capital through debt or equity? Okay, are there any legal factors to consider? Okay, so can't I do certain things? Are there policies that we need to comply with? Is there an immediate need for the project? Okay, so how necessary is the project? Okay, what's the future earnings? Okay, these are all different reasons why, or let's say not reasons, factors that would affect the decision making. Okay, so NB, always consider everything when making a decision. The more information that you have, the more likely you are going to make a better decision. Okay, and that's what they're giving you here. Factors that affect capital budgeting. Right, cash flow estimation. This is something that you've done in DSC where you've been required to draw up a system of cash flow. I don't know if you can remember the net present value stuff. Okay, so cash flow. What do financial managers focus on? Relevant cash flows.
Yes, sorry.
Okay, so relevant cash flows are cash flows that actually affect the project. Okay, it must be specific to the project. It can't be unrelated. Okay, so for example, if we're looking at VR as an option, as a project, okay, are we going to start creating VR videos? That could be an option. Okay, well, creating VR videos would be totally separate from something unrelated to VR, like filming audio. Okay, so if we're doing a podcast, okay, doing a podcast would be unrelated to filming VR. Okay, because obviously VR would be visual, but podcast would be audio. Okay, audio and visual would be two completely separate things. Okay, so cash flow here, we'll be looking at what's relevant. Okay, so what costs are relevant to the project? That's the key. Okay, relevant cash flows are cash flows that will affect decision making. Let's just write a note there. Affect the project. I'm just going to add here, affecting relevant cash flows affect decision making. That's what it's focusing on. Decision making. There we go. Okay, and that's theory. They talk about non-cash flow and they talk about non-relevant cash flow. Obviously, non-relevant cash flows aren't cash flows we're going to be looking at. Okay, incremental cash flows is looking at the next bit. Okay, so what's the benefit? What's the incremental, like the next? That's what it's looking at. Okay, you'll see this in an example when we actually do examples later on in the next chapter. Here they just talk about the cash flows and how to calculate some of it. Right, working capital we've spoken about, that's fine. Okay, here's an example. Maybe we can discuss this one. Okay, so if I relate what we just read to this example, working capital is looking at the finance, the costs. Okay, the resources, right? Okay, so in this case, let's assume the working capital required over the life of the project is as follows. Right, what is this representing? The working capital, meaning?
Yes.
How much is it going to cost us? Okay, yes. The investment. Okay, the cost of running this project. Okay, could you take all of these amounts back in time? You could if you wanted to.
Yes, sir.
Okay, you could take it all back to time 0 if you wanted to, and you could get an estimate of what all these costs would be worth at one point in time. and then you could maybe compare that to the inflows of the project rather than just what it needs to run or to operate.
Yes, sir.
Okay, so looking at this, cash flow obviously started off as 0. Okay,
Yes, sir.
then I need to spend 50k. Right, I'm spending
Yes, sir.
50,000. This is the net cash movement. Okay, so the net cash movement was negative 50,000. So obviously we ended up with a negative.
Yes, sir.
Right, then we've got negative again, so another negative. Negative again, another negative. Okay, so you can see the working capital has gone up in terms of you're requiring more and more capital.
Yes.
Alright, only in year 3 did you have an inflow. Okay, obviously the inflow is going to add to your working capital, so the negative will become smaller. Right, and then in the last year, you get a nice big inflow, which actually gives you 0 working capital.
Okay.
Okay, so sort of like a break even, if you will. Makes sense?
Not a settlement.
Pardon?
Not settling the. Is it not settle?
Well, it's a form of
settling? Is it?
settlement because the project is paid for itself, yes.
Oh, okay.
You could say that. You could use the word settlement. Yeah, generally you'd be looking at the payback period. That's something that we'll look at. Okay, which you're actually familiar with from DSE as well. Alright, sunk costs are costs that I cannot recover. Once it's sunk, it's gone. Sunk costs that cannot be recovered or recouped. Okay, this could be like marketing costs, market research. Okay, so if I'm researching whether or not VR is popular, okay, VR is still very new, okay, but it might be a growing industry. So if I do market research, how many people are actually going to want us to create VR videos? If I do the research and the numbers are very low, and I then not go with the project, well, can I cover those costs?
No, sir.
No, those costs were incurred. Okay, you did market research. The research showed you that it's still too early. There's no point going into VR yet because the industry is still growing and it hasn't been established yet as something that's being used more mainstream. Okay, once it becomes more mainstream, then we might implement a project in that area. Okay, because then we've actually got the numbers, the research that shows us that. But if I'm just looking at research, sunk costs are costs that we cannot recover. Okay, so if we cannot recover them, they're not relevant to decision making. So would I take sunk costs into consideration when doing a capital budgeting question? No, I wouldn't. Make sense?
Yes.
Okay. Wear and tear is always applicable. Why? Because you're dealing with non-current assets. And we know non-current assets generally are going to have allowances, wear and tear allowances. So this is a little bit of tax. Okay, a little bit of accounting as well. Okay, just remember from a finance point of view that assets can be depreciated and depreciable assets will carry a tax benefit.
Yes.
Depreciation is tax deductible. Tax savings. Okay, that's what we focus on in finance. Okay, how much do you save, okay, by investing in new assets? Those assets carry depreciation. Depreciation is tax deductible. It's going to lead to a tax savings. Tax savings is definitely a relevant cost, so it must be taken into consideration when doing a capital budgeting question. Okay, then they've just given you an example here. There's a statement. Okay, they show you the obviously profits. Okay, they show you income. Right, notice how the taxable income is different to the net profit. Okay, why will it be different? It's because SARS uses a different set of rules.
Yes.
Okay, SARS follows the SARS rules. Accountants follow the accounting rules. Okay, obviously the net profit after tax is different because you'll have profit for the tax, profit before tax, profit after tax. Okay, remember in finance, what are we focusing on? Cash flow. That's all we care about. Okay, in financial management, just keep it simple. Analyze. Cash flow. That's all. Okay, so anything, it doesn't matter what it is. If there's a cash flow effect, you're going to build it into your model. Okay, you're going to build it into your capital budgeting question or answer. Okay. Right, so they've given you an example here of the profit before tax. Obviously, we're adding back depreciation. Why? It's a non-cash item. See, we're looking at cash flow. Okay, so I add back depreciation because it's non-cash.
Yes, sir.
Okay, I subtract tax because I actually pay it. That's a cash item.
Yeah,
Okay, so cash flow is looking at how much cash does the business actually have as an inflow or an outflow. Okay, just a note here, depreciation is a non-cash item. So it is removed, but the tax benefit is still included. Okay, that's just a note about depreciation. Okay, so yes, depreciation is non-cash, but what depreciation provides is the tax benefit. And the tax benefit is something that you would include. Okay, and that's why you do take it into consideration when working out your cash flow. Okay, there's just some examples here looking at accounting. Okay, that's the accounting, right? And then this is the finance. The finance is obviously this bit. Let me just show you. There's the finance. Okay, finance is looking at FCF. That's the important bits. Okay, what are the cash flows? That's all it's going to be focusing on. Right, you know normal tax is applicable. We spoke about that. Okay, opportunity costs are relevant. That's another one. So we spoke about sunk costs. Let's write down opportunity costs here. Opportunity costs. These are relevant and must be included. Always. Okay, so sunk costs you never include. Opportunity costs you always include.
Yes, sir.
Okay, because they affect decision making. Must be included. Next bit, financing costs, also something that's not included. Why? Because it's looking at interest. Okay, so you're not going to be looking at a capital budgeting exercise because remember, capital budgeting is looking at debt or equity. Okay, so if I use more debt than equity, then I'm going to obviously have more interest, right? Okay, so
yes, sir.
This is looking at the way that we finance a project shouldn't affect the project, if that makes sense.
Okay.
Okay, so if I'm going to accept a project and the project is buying a camera so I can do VR. Okay, buying the camera is separate from the inflows and outflows of the project. Does that make sense?
Yes, sir.
Okay, so whether I take out a loan to buy the camera or whether I save up to buy the camera, that's financing. That's got nothing to do with the project, which is VR and creating videos. Okay, so the project is separate from the financing. Does that make sense?
Yes. Yes.
Okay. Right, then they talk about rules regarding timing of cash flow. Timing is important because you're going to always draw up a timeline. Okay, you know this from DSC. Always draw up a timeline. Once you've got the timeline, we're then going to insert things on the actual timeline to show where the cash flows are.
Yes.
Okay, and then obviously, do we need to do this in a table?
No,
I need to
sir.
do all this, Unam?
No,
I
sir.
don't. Okay, what do I need to do?
You need to.
I need to not use my calculator, right?
Yes, sir.
Okay, so on your calculator, okay, put this as CF0, put this as CF1, put this as CF2, put this as CF3. Okay, what rate are they using here? 10%. I want you to solve for the net present value. Do you get that answer?
Okay.
So type in negative 110000, press the plus minus button, then press CF on your HP.
Okay, CF.
Then type in 65, press CF. Type in 44, press CF. Type in 52, press CF. Then put in your rate as 10%, I over Y. Then go second function NPV, what do you get?
Second function NPV 24,522.
Yeah, you can see your answer is more accurate because you're not rounding off stuff.
Yes.
Okay, here they're rounding off stuff. Why? Because they're using the table method. Right, if you turn a few pages toward the end, you'll see they give you the actual tables for discounting future cash flows. Right, that's a very inaccurate way of working out time value of money in a world where we have financial calculators.
Yes.
Alright, so you're always going to do it on the financial calculator, and you're going to be working out the net present value, which is the NPV, using what we just spoke about now, the cash flow function. Okay, got that?
Yes. Yes, sir.
Great. Okay, that's just a little bit more additional workings here. They've given you an example there. They've spoken about discount rate. We know discount rate is what? It's the I over Y, taking things back in time. Discount means work out the present value. Okay, that's revision for DSC.
Yes, sir.
Okay, then we've got the techniques. This is the last bit for tonight, is the payback period and the average rate of return. Alright, so if I'm looking at the capital budgeting technique, there are many different techniques. Tonight we're just going to look at the first two. Okay, so NB, these are very, 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 very important. Capital budgeting techniques. Okay, so these you have to study, these you have to know. Number one, payback period. Okay, payback period is easy. When do I pay back the initial investments? Okay, you've covered this before in DSC, it's more revision than anything else. Okay, just to recap, payback period is looking at this, time 0, INV. Then you've got time 1, time 2, time 3, time 4, and so on. Okay, the initial investment will be negative, so let's just say negative 1 million. Ooh. Okay, no, come on, this 1 million, there we go, like that. Negative, minus. Okay, so that's the initial investment. Okay, and then obviously an initial investment is going to create inflows, so maybe 100k every month. Right, so what is this? That's the cash flow. Right, and obviously you need all of it in order to do the payback period. Okay, so when do I actually receive the payback? So if I keep going, okay, this is going to go all the way through to time, let's say 10 or 20 even. Okay, so obviously if I'm getting 100,000 every month, when do I pay back the initial investment? After 10 years. 100k times 10 years equals 1 million. This pays back the initial investments. Make sense?
Yes, sir.
Okay, that's payback period. Very simple calculation. Right, so let's have a look at them. I just covered the first one with you. It's on the next page here. Where is it? Okay, this is self-assessment. There's payback period. Okay, so we just spoke about what the payback period is. There we go. It's the amount that, it's the time that it takes for us to pay back the initial investment. Okay, basically break even. It's looking at where is the break even point. Right,
Yes,
how
sir.
soon do I have to wait in terms of getting back my initial investment? Right, obviously, from a resource point of view, you want to get back what you put in as soon as possible, right?
Yes, sir.
Correct. Okay. They do talk about some advantages, disadvantages. Okay, just to recap some of this, we've spoken about this in DSC, so you've covered this before in a previous module. It's easy to calculate. You can accept or reject. It doesn't take compounding into consideration. There's no time value of money here. Okay, that's the major disadvantage. Okay, and you don't look at future cash flows. You just look at when do you pay back. Alright, and then the last bit is that the accounting return. Where's that? Let's just find it. There's it there. Okay, so I'm going to copy this equation. It's a little bit different to AAR. I can't remember exactly what the formula was with DSC. It's been quite some time since we did that module. But maybe just to copy this here, that's number 2. Okay, ARR. Okay, the accounting rate of return. Right, so with the accounting rate of return, we need to take the average. I think in DSC they talked about average rate of return. They didn't talk about accounting rate of return. Okay, so obviously in finance, we get information from the financial statements. Okay, so the financial statements will have a net profit after tax, NPAT. Right, so this is used to determine the ARR, okay, the average rate of return. Right, how do I get the average rate of return? Well, it's the average net profit after tax. Okay, so average would be add up everything, divide by the sum, divided by the average investment. Okay, so how much do I invest? Right, I do want to look at an example here because this is a little bit different. You haven't really done this before. So let's do an example just to show you how this works. Let's find one here. Okay, that's the theory. Where is a good example? Summary. Okay, let's do one of the self-assessment ones then. Here we go. Let's do this one. Question 1. Okay, this is the end of this chapter. I'm gonna do this one as an example. Okay, question 1. Right. The payback period. We'll do it as well. Might as well. So that we've done both. Okay, let's just do. Okay, what page is this on? Page 114. Okay, page 114. Okay, payback period calculation. Right, what do I have here? Let's draw a timeline. Project requires a cash outlay of 200,000. T0 minus 200K. Initial investments. Following? You okay?
Sir? Yes, sir. Yes, sir. Yes, sir. So I'm looking at the example.
T1, T2, T3, T4, T5, T6, so on. Okay. What else do we have here? Generates cash flow savings in operating costs after tax of 80, 70, 40, 30. 80, 70, 40, 30. What else? During the next 4 years. Okay, that's it. Depreciation of 50 per year has not been deducted from the operating cash flow. After tax figures, as it is a non-cash item. Okay, so here they said depreciation of 50 per year has not been deducted from the operating cash flow. Would you deduct this from the operating cash flow? No, you wouldn't. You have to add it back.
No, you wouldn't add it back.
Yeah,
Yes.
so you would add it back, not deduct it. I don't quite understand why they're giving you that, because they gave you the after tax. Did they take that into consideration? Okay, for the AAR, yes. Right, so we'll look at the AAR. But yeah, it's not going to affect the...
Oh yeah. So adding back the depreciation is for cash flows, not for ARR.
Let's just read this again. The cash generates cash savings in. cash savings in operating cost after tax. Okay, so it's a saving of the cash from the operating tax. So that's the savings. Yeah, no, you wouldn't have to. Okay, it's the savings. Okay, what else do we need to work out? We just need to work out the amounts. Okay, so here they've used the payback period. Okay, 200,000 minus 80,000. This was operating. Okay, no, they're using different cash flows. This is what the diagram looks like. Okay, that's the initial investment. Those are the inflows. They said
are there
cash flow savings. Cash flow savings is the relevant cash flow.
Yes, sir.
Okay, so let's check. When do we pay back? 80 plus 70 is 150. 150 plus 40 is 190, right? Okay, so 190,000 there. You still don't have enough. Okay, so it'll be 3 years plus how much do I want in the last year? I want 10,000 over 30,000. Okay, so 3,3333333 years payback period. Do you agree?
Yes, sir.
Okay, that's when you pay back the initial investment. Makes sense?
Yes.
Right, what did they get here? 3 years and 4 months? Yeah, that's the same thing as 3,3 years.
Yes, sir.
Okay, obviously 3.333333 times 12 months. Or let me do it this way. Oh yeah, that's fine. Okay, so that'll give me what? Times 12. Times 12m. Okay, so 3.33333333 times 12 equals 40 months. Okay, which is 3 years and 4 months. If you convert it back to months and years. Got that?
Yes. Yes, sir.
Okay, average accounting rate of return, just copy paste that. Okay, that was the first question. This is the second question. Alright, so here they said average net profit after tax. See, after tax. Average net profit after tax. So average means sum up and divide by 4. Okay, what do I have here though? Okay, see, I need to work out the net profit. Okay, so depreciation of 50,000. The average net profit would be the sum of all of them divided by 4. Okay, so there's the average. Okay, so average net profit after tax, 80 plus 70 plus 40 plus 30 divided by 4 equals
55.
Yeah, 55. Okay, so that's the average net profit after tax. Okay, average net profit after tax. I see they've subtracted 50 here because they said in the question depreciation of 50 per year has not been deducted from the operating cash flow after tax figures as it is a non-cash item. Alright, see, what am I using here? This is accounting, not finance.
Yes,
Okay,
sir.
so if this is accounting, not finance, do you take depreciation off? Yes, you do.
Yes, sir.
Okay, depreciation is deducted as an expense when you look at net profit. Do you agree?
Yes, sir.
Okay, so ARR is therefore open brackets 55 minus 50. Okay, divided by, there was no average investment here. They just gave you 200,000. So you just put the 200,000.
Yes, sir.
Okay, times 100 equals an amount. Come on, give us an answer. 2.5%. 2.5%. Oh, average. So they want you to work out an average even though they didn't give you a opening balance. That's odd. Okay, but I see that's what they've done in their solution. Okay, I wouldn't have used an average here because they didn't give you the average initial investment. Okay, they only gave you one amount. So looks like they do want you to work out an average even though they didn't say anything about the beginning of the year. Okay, that's strange. Okay, but it's what they've done in the question. Right, so I had 2.5% here. Okay, if you do use an average, assuming 0 as the opening or as the closing, well, or let's say 0 as the start and end, divide by 2, average investment as part of the average investment. Okay, then you land up with the other answer. Okay, so let's just show that. Brackets 200 plus 0, close bracket, divide by 2, close that bracket. Okay, gives me 5%. See that? Is that right?
Okay. Yes, sir.
Okay. Alright, so that's pretty much it. We've covered that at least. So I'm going to start with the more difficult techniques next week. Okay, we'll be looking at cash flows. We'll be looking at the other techniques. Okay, the net present value, the IRR, all of that stuff. Okay, so we'll start with study unit 21 next week. We've covered quite a bit today. There was more theory today than workings. There weren't that many workings. It was just one or two. Sorry, question?
No. So I'm listening.
Oh, you're listening. Okay, yeah. So
yes.
It's a lot of theory in terms of what capital budgeting is and what capital expenditure is. And remember, capital budgeting is important because that's the decision making. Where do we allocate resources and what return do we get?
Yes, sir.
Right. Happy?
Yes, sir. Thank you very much.
Great. You're welcome.